This is a Momentum Media production.
Property Finance Uncut, the must-listen podcast for anyone with a mortgage. Find out the truth about what Australia's lenders are up to and how to make sure you're in the best possible position when it comes to your property finance.
Good everyone, how you going? Phil Tarrant, Property Finance Uncut, November 2022. Two key things today. Interest rate hikes, Melbourne Cup. What's more important? Who knows? But we've seen today 25 basis points increase to the official cash rate, taking it up from 2.6%. We are definitely in a rising rate environment. Joining me to break it down, unpack it, Paul Glossop, CEO, Finni Mortgages. Paul, how you going?
Oh, very well, mate. Very well. It's very, very close to the barriers opening, mate. Who's your tip?
My tip is don't gamble, particularly on property.
Or the Melbourne Cup, for that matter. You've got 24 horses running around for 3 laps and absolutely no idea.
Mate, I can't give tips on it.
No, of course you can't.
I'll give you a good tip though.
Okay.
Make sure you got a sharp interest rate.
Yeah. Absolutely.
That was pretty good, wasn't it?
Very insightful.
Anyway,
One
we
of your
mess
best.
around. No. So, Paul, we've seen the RBA's come out again with another rate announcement. What do we know so far?
So we know that we're essentially up now. So we're up as probably much, much closer to where we will be at the top. And I know we spoke about this last month, Phil, where we kind of mentioned that we got this 0.25 increase, which was probably a little bit against the grain. We were expecting another 0.5 and then maybe some tapering by about this one that's just come through. But the reality is now we're very, very close. I think CBA have mentioned that they expect that we'll be hovering around that 3.1 range. A couple of the other banks are sort of slightly above that. But I think the reality is now that money's going to be pretty close to the top of what we're going to be paying for it for the foreseeable future. Okay. So uncertainty is starting to probably push back to where it was mid-2022. And I think we're entering into more certain territory.
Yeah, I think the government sees similar as well. Federal budget last week, as we all know, and then the budget response on the Thursday. I was down in Canberra for all that sort of stuff. Always enjoyed. I spoke to the Shadow Treasurer, Assistant Shadow Treasurer, one-on-one, and had a good chat around where they see it. They sort of similar view towards you. So what do Australians do about it? Rising rate environment, inflation highs. It was 7.7%, the biggest it's been. What do you do about it, mate?
Well, I think it's going to be relatively similar to what's probably already started to happen. I mean, one thing that I think will be interesting is to see how much we actually curb our spending, because we're going into what is spending season when it comes to Christmas, and this is something that we'll probably won't know how much we spent in February, March. I'm not here to tell people don't spend too much on your kids at Christmas, but one thing you can do is obviously rein in those things which you're leaving the majority of your money on your table. And the reality is the two main things that most households spend either too much or too little money on, or when I say too little, where they're actually shaving the pencil or sharpening the pencil where they can, is essentially what their household costs to run and what their cars cost to run. Now, cars we're not going to talk about, but household we certainly can. And that essentially comes down to the majority of the costs is revolving around what a mortgage costs to operate. And we've spoken about this so many times this year, is the fact that the last 4 or 5 years, you leave your interest rate variable and essentially you just throw caution to the wind. You've probably done the best you possibly could have possibly done, because the market really dictated cheaper rates on a quarterly basis. But now we're going into this atmosphere of unknown territory. You've got some banks who are forecasting much higher interest rates in the future, so their fixed rates are now much, much higher for that 3 and 5 year timeframes. And you've got others like the CBA we've just spoken about who are saying we're pretty close to the top. Now, this is where people can do something about it. Now, I'm not suggesting that you need to fix nor leave it variable, but depending on where you're starting, there's those 3 main tranches that we're now starting to see. So those people who fix their rates around about 2 years ago, we're seeing the first major tranche. I think it was about 440 or 50 odd billion is basically coming into variable in the next couple of months. Then there's going to be another section that's going to be around about mid next year. And then the third section is around about the end of next year. So there's 3 main areas where people who fix their rates on cheap loans, and I know you're one of them, Phil, where you're now starting to think, hang on a second, I fixed that at 2.5%, however long ago it was, might have been 12 months, 24 months, and you're starting to think, hang on, once this rolls over to variable, there's going to be a huge change in that price, and that's a given. But the difference of what that can be to versus what it should be, that's the conversation with your broker.
So you need to know what's going on. How do you know if and when your interest rate's coming off fixed rate period?
Well, I'll ask you that question, Phil. How do you know when your
I know
rates...
exactly because it says it on the bank fee.
Well, there you go.
There you go, but I don't think a lot of people know that.
No, exactly. But this goes back to the economics. And I personally, if I go back to my mortgages that sit on my properties right now, I get them in different ways. Some of them are still coming in the mail. I try to transfer them over to be coming electronically, whether it's email. Some of them go to spam. Some of them come up as a notification on my net bank. It's a variety of different ways. So the key for me, and I'm always, my simple solution to this is I ask my broker. I don't go, because I've got 4 different banks that I use for a variety of different loans, and the reality is for me to go to the different methods of actually understanding when they're coming off variable, what I'm paying based on this increase, that's just happened today. How much is my bank going to be passing on? Is that different? Should I be having a different conversation? Always go back to my broker. Give me a summary of where all of my loans sit, where the structures are, when they roll over, if some of them are fixed, when they're rolling over to variable, and what should we do about it at that point in time.
So you can call it your broker and they can
You
start
should be.
modelling what it looks like for you.
100%.
Yeah.
100%. And it's probably more, I'd suggest it's always best via an email, phone call followed up by an email, because I always want these things in writing. So I want to know security X, what am I currently paying? With this change, what will I be paying? What options are going to be out there? Can I do anything about it? And previously, that conversation was saying, the reply basically should have been, don't do anything about it, let it play out. Now, I think it's a lot more, hey, it might be time to do these 2 things we've harped on about, a little bit like a broken record now. You've still got a ton of equity sitting there. If you haven't touched it, time to get it out. And if you're sitting on a rate that was fixed, now variable, and it's floating around in the ether, I'd almost guarantee that there's going to be a sharper rate that should be achieved based on what you've probably already rolled over to.
So if your bank just rolls over your fixed rate loan to their variable rate loan, you're probably not going to get any discounts on that.
Absolutely.
They're going to ratchet right up.
Minimal. And you're talking, and typically what I see, and you've probably experienced the same thing, Phil, if you're rolling from a fixed to a variable, you're talking probably 0.5% difference on what you should be getting versus what you'll be receiving straight off the bat. And that's based on the fact that it's path of least resistance. You don't kick up a stink, they're unfortunately not going to be looking after you.
I'll tell you a red hot tip. The bank's not going to go out of its way to give you a sharp rate.
Really?
Yeah. No, believe it or not. Well, the thing is that it comes when you sign your mortgage documents for a fixed rate. There'll be things saying when it comes off fixed, it'll go on to the standard variable rate. And they may factor in a discount at that point in time, but you probably didn't even look at it when you signed your mortgage document.
Yeah, absolutely.
So that's you. So how long before your rate's coming off fixed to variable should you be chatting to your broker?
I'm a big fan of anywhere between 3 and 6 months. Okay. Because, you again, going back to your situation, I know from mine personally, I've gone through a refinance which is still going on, and I started that 5 months ago. Depending on how complex your situation is and what kind of actual refinance you might be wanting to do, the reality is it could take actually quite a long period of time to go through the process of A, pricing, and B, servicing, and then figuring out where to place that debt. Now, whether that debt's somewhere else or to stay with the same lender, and having that conversation with your broker around that whole time. The other big thing too is that a lot of people get probably maybe a little bit misplaced with their thoughts on, if my rate's fixed, I can't do anything until it's unfixed. And they think there's a huge break fee cost. Now, remembering that break fee costs get lesser and lesser the closer to the actual date that it rolls over. And so, when I say sometimes, a lot of the time, especially in this competitive environment, almost every lender out there is prepared to pay break fee costs for loans that are typically anywhere between 3 and 6 months off their fixed period, plus give cashbacks.
So a different lender will cover the cost of break with the other lender.
Potentially, yeah, absolutely. Okay. And that's a big one because a lot of people think, I've got to wait. And then by waiting, you might have missed a special or a cashback opportunity or being able to get that equity out at a time where it was more favourable. So don't wait until, hang on, it's now variable. Now I can have that conversation. 3, 6, maybe even 8, 10 months out. They're the times where I'd start to prospect, have those conversations, get your documents in order, things like getting your 2021s, getting them ready for your broker to actually be able to place, discussions with your accountant, make sure your tax is done for last financial year. All those different things get you ready and prepared to just say, here it is, I'm ready.
So if your broker shows you numbers that make you a bit nervous based on the resetting of interest rates to variable, you can actually work on the sort of household budget as well, right? You start making cuts now.
Yeah, exactly, mate. Because they might give you that exact feedback to say, hang on, things are looking a little bit shaky here. You might need to be aware that when these numbers do roll over to variable, here's what you're going to be in order for. And it's for a lot of people, it's going to be a distinctive amount of money. I mean, we did the math this morning that the difference between April and now for a $500,000 mortgage is about $10,000 a year difference. If you're a variable between that whole time,
it's a lot of money.
It's a lot of money. It's a lot of money, and it's not all that money's not going out the door. There is definitely ways to make that money back, but I'm not going to jump on that. This is a show about how to maximise your finances, but in saying that alone, if that's a $500,000 loan. If you've got $1 million, you do the math and you keep going, extrapolating that further and further. So, certainly conversations that should be happening now. And I use the analogy where basically, if anyone follows things like soccer, rugby league, netball, or netball's probably in season now if you're that way inclined, but you don't enter the pitch or start the game without a preseason. And your preseason is where, for the good teams, that's where your hard work's done. And if you want to go be ready, and not only be ready to buy, but be ready to maximise your cash flow, this is your preseason. Yeah. This is where you do the hard work. Match fit. This is where you get, it's frustrating and it's hard work, and it's those times where you don't want to get out of bed early and your coach is yelling and you're like, we don't play for another 6 months. Well, this is the time when you separate the proverbials.
There you go. Got to be match fit. Now,
match fit.
A lot of lenders have still got a lot of specials, if you want to call it that, out there, incentives to come on over. What sort of rates are you seeing in the market?
Yeah, mate, we like to do this every month because I think it gives actual real numbers. So I like to break it down to typically to owner-occupiers. So best rates for owner-occupiers, if you're on P&I, you're definitely able to still attract around 4.8, 4.9% for owner-occupiers who are P&I at the moment with a 20% deposit. Investment loans at P&I, again, you're not too far off. You're around about that 4.3 to 4.4% for a P&I. Interest only is not a long way off that as well. So there's a lot of people out there, and vast majority of investment holders have got more than an 80 or better than 80% LVR still. If you go down the commercial rate, there is big fluctuations there. And I know you've got a lot of commercial investors who listen to your broadcast across a whole bunch of different channels. We just did a loan for an investment client only as of earlier this week. It was a lease doc loan, 80% deposit. So essentially,
80% deposit.
Sorry, it's a big deposit. 80% LVR, so 20% deposit, which was refinanced or accessed from a residential property. Took that as a $390,000 purchase, 3+ 3 year lease on that, so they could take the lease and that service loan. Didn't service it with their actual own income, so their serviceability stayed untouched, and they're going to buy other residential property with that. But that was a $390,000 purchase at 5%. On the button with ANZ.
Okay.
So you're talking 5%. That property itself had about a 6.4% net rental yield, so they were cash flow positive on that. Took a deposit from one person, so 5% on the commercial front. And a lot of people are getting smashed with high fives, early mid sixes. So that's something where you can sharpen the pencil exponentially. And last one is SMSF Resi, which again, if you talk about rollover, that is the number one where majority of investors who are buying SMSF Resi purchasers who potentially have bought them 12, 24, 36 months ago, they're the people who potentially can be on north of 7% right now, where they should be in that mid 5% range.
You get mid fives on Resi
Mid-fives
SMSF.
and Resi SMSF, sub 80% LVRs.
A lot of people think because it's in SMSF, you can't sort of reprice a loan in time.
It's the same deal.
Yeah.
If anything, it's a little bit easier in certain scenarios.
A few more lenders have come back into that market, though.
A lot more. Compared to Royal Commission into the banking sector. 4 years ago, you were talking it was a wasteland. There was 2 or 3 lenders for a good period of time. Now, it's open season again, which it should be. I mean, ultimately, it's money for jam for a lot of these people. They're very easily serviced loans.
Yeah. So, in conclusion, what's the most important question you need to ask your mortgage broker today?
Ooh, that's a good question.
Which barrier?
Johnny, well, you've got about 5 minutes before you ask that question.
Yeah.
Now, for me, the question is what do I need available for you to price my loans? So it's not what can I get, it's what do you need for me to show you so you can then go to the market. So ultimately, take your shirt off, show me your physique, how hard you've been working the off season. And that's essentially what I'm here to say is that, look, show me your numbers before I can tell you what we can do. Yeah. And you've got to go to them and say, ask them what numbers they want to see. It's not because a lot of time people think, I've got my pay slips. But if you own one investment or if you've got a self-managed super setup or you've got other things there like maybe a Hexstead or other things which are sitting out the ether, you might have a lease, a car lease, a novated lease that sits in the background, certain credit card limits, all these things, they'll tell you, show me this, this and this, and I'll tell you what we can do and can't do. So that's the question. Go to your broker, ask them, what numbers do you need to see from me for me to then be able to give you that, and then you be able to show me what the best I can get in the market will be.
All right. There you go. Paul Glossop, Finni Mortgages. Thanks for that, mate. Go and check these guys out. This is Property Finance Uncut. I hope you enjoyed that, everyone. We'd like to come back every single Tuesday at the start of the month. We'll have a small break in January because RBA's on holidays then. So guess what? I can give you a news flash. It's not going to be anything that's going to happen to rates right then. We'll see you again next time. Until then, bye-bye.